Welcome back to the Working Thesis. Yesterday, we left off with a major question hanging over the market. We know there is a massive artificial intelligence construction site underway, but will the building actually get occupied? Will the tenants arrive and generate the cash flow required to justify the heavy capital being spent?
They arrived in meaningful numbers. The tenants showed up with suitcases in hand, eager to move in. But the landlord took one look at the line stretching out the door and immediately ordered another massive tower to be built. So while the rent is clearly growing, the construction bill just got significantly larger.
That is the central tension of the market right now. At least in Alphabet's results, the weak link was not customer demand. The harder question is the timing of cash flows and whether near-term cash generation can keep pace with the sheer scale of the capital expenditures required.
And that dynamic played out in today's session and the after-hours reports. We have a market trying to digest an environment where top-line growth can look fantastic, but the construction bill is causing near-term indigestion. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
Let us look at how that indigestion priced into the U.S. indexes by the close. The Dow finished at 52,218.58, down 0.01%. The S&P 500 closed at 7,498.96, down 0.14%. The Nasdaq Composite ended at 25,690.90, giving up 0.57%, and the small cap Russell 2000 closed at 2,959.94, down 0.92%.
Those are red numbers across the board, but the volatility index changes how we read them. The VIX actually fell to 16.64, which is a decline of 2.4% on the day.
Exactly. When the Nasdaq and Russell slip while implied volatility also eases, the combination is more consistent with repricing than panic. It does not prove why every investor moved, but it tells us this was not a disorderly rush for protection.
The tape looked more like rotation and multiple adjustment. Some growth premiums compressed, while utilities, materials, energy, and selected semiconductors held up better.
That measured tone was visible globally as well, though with a regional split. In Asia, markets were softer. The Nikkei closed at roughly 66,116, which is down about 0.18%. The Hang Seng finished at 24,892.66, falling 0.95%.
Europe, on the other hand, caught a bid throughout their day. The broad stocks index was up about 0.58%. The DAX climbed 0.58% to close at 25,155.41. And the FTSE 100 led the major European boards, rising 1.24% to finish at 10,717.
Checking in on the crypto complex, which trades continuously, we are looking at an evening snapshot where Bitcoin was trading around $66,000 and Ether was hovering around $1,930. We saw muted action in the tokens themselves.
But the equity side of the crypto ecosystem took a noticeable hit. Coinbase fell 5.53% during the regular session to close at $166.12. That aligns with the broader softness we saw in speculative tech.
Turning to commodities and rates, there is a clear geopolitical premium. The ongoing U.S. and Iran confrontation, specifically the shipping risks in the Strait of Hormuz, kept a firm bid under energy. WTI futures were trading roughly in the high 80s, and the USO oil fund closed up 2.2%.
That energy bid translates into an inflation premium, which we saw reflected in the bond market. The U.S. 10-year yield ticked higher by about 3 basis points, settling around 4.66%. The U.S. dollar index, the DXY, was essentially flat near 101.
With that geopolitical tension and sticky yields, gold and miners had a very strong session. GLD was up 1.15%. The gold miners ETF, GDX, jumped 3.36%, and the junior miners, GDXJ, rose 3.57%.
That combination is consistent with capital moving toward tangible assets. When shipping risks rise around a critical choke point, commodities and extraction equities can act as a hedge against supply shocks, though one session does not establish a durable regime.
That migration into tangibles showed up clearly in the sector splits. Utilities, XLU, surged 2.25%. Materials, XLB, gained 1.44%. Energy, XLE, was up 1.2%, directly tracking that crude bid.
Meanwhile, the growth in consumer sectors lagged. Communications, XLC, fell 0.75%. Consumer discretionary, XLY, was down 0.74%, and healthcare, XLV, slipped 0.51%. But the most glaring divergence was within the technology sector itself.
Right, the semiconductors managed to stay in the green. The SOX was up 0.51%, and the SMH gained 0.48%. But the software sector took heavy damage. The IGV software ETF dropped 3.05% on the day.
It is a continuation of the hardware versus software gap. The physical layer kept a relative bid, while the market took a much harsher red pen to software multiples.
Which brings us to the centerpiece of the day, Alphabet's Q2 2026 earnings report. The numbers offered strong evidence that enterprise artificial intelligence demand remains robust. Total revenue was $119.8 billion, up 24% year over year.
Google Cloud stood out. Cloud revenue hit $24.8 billion, representing 82% growth. That is a very large base growing at an unusually fast rate. Cloud operating income came in at $8.8 billion, which implies an operating margin around 35.5%.
And they have a cloud backlog sitting at a massive $514 billion. Management was clear on the call. They accelerated the delivery of capacity to meet this growing demand, and yet they still describe themselves as being in a capacity-constrained environment.
Those are strong indicators that customer usage and commitments are expanding. We still cannot see a simple, company-wide capacity utilization rate from the outside, but demand was clearly not the missing piece in this quarter.
But then the financial bill for all that construction arrived. Despite massive top-line strength, Alphabet reported quarterly operating cash flow of $39.1 billion against Capex of roughly $45 billion. That resulted in negative free cash flow of $5.9 billion for the quarter.
And they raised their full-year 2026 Capex guidance significantly. They are now projecting $195 to $205 billion in capital expenditures, up from the previous range of $180 to $190 billion. They are spending heavily to build the infrastructure required to service that backlog.
Shares fell roughly 3 to 4% after hours. The revenue is spectacular. The demand is undeniably real, but the upfront cost to capture that demand is consuming the operating cash.
It is exactly what management noted: accelerated delivery of capacity. When you pull forward data center builds, you pull forward the cash outflow. The market is digesting the reality that the cash harvest is delayed by the scale of reinvestment.
A high-growth operating quarter coincided with enough capital spending to tip free cash flow negative, and the shares repriced lower after the report. Let us go back to our building analogy from yesterday, because this Alphabet quarter maps to it unusually well. Think of Google Cloud revenue as the rent being paid by commercial tenants. That rent is growing 82%. More floors are occupied, and the rent roll is rising quickly.
But the capital expenditure, that $195 to $205 billion guidance, is the construction loan for the next set of towers. You pay to pour the concrete, secure the power, and install the servers today, often quarters before the new tenants can fully move in.
That creates a timing mismatch on the cash flow statement. Cash goes out the door today to pay the suppliers and builders, but rent comes in incrementally over many quarters and potentially years. So in the near term, free cash flow drops into the red.
Exactly. And what we have not even fully touched on is the depreciation schedule. Eventually, all that capital expenditure transitions into depreciation expenses on the income statement, impacting earnings down the road. But right now, it is a cash flow timing dynamic.
Negative free cash flow by itself cannot tell us whether a business is failing or reinvesting. In this quarter, it coincided with an unusually large, self-funded expansion intended to meet contracted demand. I can hear a natural listener objection forming right now. Someone is thinking, if cloud grew 82%, the margin expanded to 35.5%, and the backlog reached $514 billion, why on earth did the shares fall 3 to 4%?
It is a great question. One way to interpret the reaction is that the market scoring system has moved forward. Demand validation still matters, but investors are now also asking about return on invested capital and the timing of free cash flow.
The market may already have priced in a meaningful portion of the demand story. The new information was that capturing that demand requires an even larger near-term build.
Chuckles. In the language of our analogy, investors are saying, we can see the tenants. Now help us understand when the rent covers the construction loan and begins accumulating as surplus cash.
Raising the Capex range by $15 billion can lengthen that investment phase. The after-hours decline is consistent with investors extending the timeline they use for near-term cash conversion, though no single price move gives us a perfect explanation.
So intact demand and a lower share price can coexist. The valuation math may have changed because the cash reward could arrive later than the market previously assumed.
We saw a different flavor of this dynamic with GE Vernova. They reported official Q2 2026 revenue of $11.1 billion, up 22%. Orders were a massive $24.2 billion, up 88%, pushing their backlog to $176.3 billion.
Their cash conversion was strong, which gives us a useful contrast with the hyperscalers. Q2 free cash flow was $5.1 billion, and they raised full-year free cash flow guidance to a range of $11.5 to $12.5 billion. Power and electrification are converting substantial demand into cash.
But wind remained the counterweight. Wind orders were down 40%. Wind revenue was down about 11%, and the company expects a full-year wind EBITDA loss around $400 million.
Management cited weak U.S. onshore volume and higher offshore project costs. The shares fell 8.69% during the regular session, alongside that mixed segment picture.
It shows that supplier demand does not remove execution risk. A large backlog, strong cash flow, and a difficult business segment can all be true at the same time. Let us pivot to ServiceNow, because it gave us a clean example of the difference between a market narrative and ground-level operating data. For Q2 2026, the company reported subscription revenue of $3.877 billion, up 24.5%.
Current remaining performance obligations, or CRPO, hit $13.2 billion, up 21%. Total RPO is now $29.0 billion, also up 21%. Crucially, their AI annual contract value officially crossed the $1 billion mark.
They even raised their full-year subscription revenue guidance to a range of $15.76 to $15.78 billion. During the regular session, shares fell 6.47%, dragged down by the broad software sell-off we saw in the IGV.
The shares then recovered part of that decline after hours once the results hit the tape. The software market story was weak, while ServiceNow's reported operating data still showed strong contract growth.
We also had official numbers from Tesla. They delivered a record top line with revenue hitting $28.24 billion, up 26%. And they confirmed record 480,126 vehicle deliveries for the quarter.
But beneath that impressive top line, the margins are thin. The GAAP operating margin was just 1.4%, resulting in adjusted EPS of 33 cents. Just like Alphabet, the heavy capital intensity weighed on the cash statement, with free cash flow coming in at negative $1.09 billion.
Q2 Capex was $5.79 billion, and they guided full-year Capex above $25 billion. The shares fell more than 4% after hours as the market processed those capital requirements.
It applies a similar financing test to manufacturing and autonomy. Tesla reported record deliveries and revenue, while the cost of building the next generation of factories and computing capacity consumed cash.
The heavy Capex cycle spares no one who is trying to scale physical infrastructure globally. Speaking of infrastructure, IBM reported Q2 revenue of $17.162 billion, up 1%, with operating EPS of $2.93. The underlying segments tell a story of natural hardware cycles versus software consistency.
Right. Infrastructure revenue was $3.835 billion, down 7%. That was driven by IBM Z revenue plunging 42% as the mainframe product cycle lapped its peak, even though distributed infrastructure grew 37%.
Meanwhile, software revenue was $7.761 billion, up 5%. Red Hat grew 11%, and data was up 19%. IBM noted they faced revenue headwinds late in the quarter, but software growth remained intact.
The quarter asks us to keep two layers separate. IBM Z was lapping a strong mainframe product cycle, while software still grew 5%. Both were true at the same time, and the segment data matters more than forcing the whole company into one simple technology narrative.
Let us tie this back to the broader theme. When you look at Alphabet's heavy spend and Vernova's cash conversion in power, it highlights a structural reality, the timeline of who collects cash first.
Many suppliers selling chips, cooling systems, and power equipment can recognize revenue and collect cash earlier in the construction phase. The owners building the data centers carry more of the immediate Capex and the eventual depreciation.
They then wait for utilization, the rent in our analogy, to scale enough to recoup that outlay. But this timing advantage is neither permanent nor universal. Supplier orders can normalize, projects can slip, and some owners may convert usage into cash faster than others.
Smiles. And everyone still has to execute. Vernova's wind results show supplier-side execution risk, while Alphabet's negative free cash flow shows the owner-side cost of reinvestment. Managing the transition from builder to operator is the hard part.
The market appears highly attuned to who is carrying that financial risk right now. Looking ahead to Thursday, July 23rd, we have more evidence coming to test these themes. Before the U.S. Open, we will hear from Freeport-McMoRan. At 8:30 a.m. Eastern, we get the initial jobless claims data.
We also have EIA natural gas storage at 10:30 and the Kansas City Fed manufacturing survey at 11. Over in the European morning, SAP reports, which will be another major data point for enterprise software health.
And after the U.S. close on Thursday, Intel and Newmont report. Freeport and Newmont will serve as tests of how well miners are converting elevated copper and gold prices into cash flow against rising operational costs.
Intel will provide another read on the Capex versus utilization dynamic, including how its foundry investments are progressing against broader demand for silicon capacity.
Which brings us to the open question we carry into the rest of the week. What evidence would show that this construction cycle is translating into sustainable economics?
We have to watch the Capex to revenue ratios very closely. We need to monitor cloud operating margins to see if they hold the mid-30s or face compression. We have to track utilization rates, backlog conversion speed, and how the eventual depreciation curves impact earnings. Ultimately, it all comes down to the trajectory of free cash flow.
This is a likelihood game. No one can predict the future. Just one read of what the setup looks like today, based entirely on the cold, hard facts the companies are reporting.
Until next time, take care and keep following the money.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.